Hello everyone, this is Dwayne Malone. Welcome to the ECAM blog market update as of the market close on Friday the 27th of August 2010. This morning I put up a blog outlining a lot of the charts that I've been looking at in the last week or two. I would suggest that you go and read that blog because there's a lot of information in there that I won't cover in today's video, but it'll give you a good idea as to the indicators I'm looking at. Of all the charts that I discussed, I'm just going to discuss two of them. One is the 60-minute chart, and the other one, the weekly chart. As you can see on the 60-minute chart, we entered a trading range back in May, mid to late May, when we broke below 1131, and we have remained within a trading range between 1131 on the high side, 1040 on the downside now for the last almost 4 months. We had a minor incursion down south to 1010 here back in late June, early July, and since then we have maintained once again within this trading zone. Until this resolves to either the upside or the downside, it has to be assumed we're in a trader's market where there really is no firm indication upward or downward. Having said that, on this shorter term trading chart, you can see that I've got this red line indicating that my technical indicators went bearish back about the 11th of August. And we did attempt twice this week to break below 1040. We stopped basically at 1040 both times, and we were able to close above 1040 on a daily closing basis. You can see there is this downtrending channel, which we appear to be within. Upside on that's about 1062 or so, with a downside currently down to around 1020. So in the next couple days, this should resolve one way or the other. If it does resolve to the downside and we break 1040, especially if we close below 1040 on a daily closing basis, that would be one of my primary indicators to indicate that it is now time to move out of equities in the Provident Fund and move 100% back into cash. As of today, that is not the case, so I'm going to have to wait till early next week to see which direction this market wants to go. The second price chart I want to discuss is the weekly chart of the S&P 500 index with the 1334 exponential moving average crossover. As I blogged previous, we had a negative crossover back in late June. We did cross back in late July to a positive crossover. That only lasted 1 week. And then the following week, the first week of August, we crossed back over negative. As you can see, as of today, the 13 versus 34 is spreading in a bearish direction. So therefore, it must be assumed that the direction of the market going forward will be down. Having said that, we are between 1065 on the downside and 1136 on the upside, as indicated right here. And that is our trading range on a weekly closing basis. You can see that interweek, we broke down here this week, got down to 1040 as I discussed. However, by Friday, the bulls had pushed the market back up and closed for the week back above 1065, essentially at 1064.59, so 1065. So once again, we're still within this beige zone. It could go either way. If we were to close on a weekly closing basis below 1065, then that would be another indication to me that we have entered a new bear market phase, and it would be time to exit all equity positions in the Provident Fund and back into cash. Once again, we are sitting on the line, so we have to let next week decide for us what direction we want to go. Until then, it's a little bit premature to indicate what direction we might be headed. The next chart is the US dollar index chart going back to February of 2010. As I discussed previously, we were in a large consolidation zone between about 79.51 to the downside, topping out at about 82.24. In late April, we broke above that congestion zone, and that initiated a very strong uptrend in the US dollar. That topped at 88.71, and that was back in the first week of June. And we've been in a decline ever since in the U.S. dollar. As you can see, there was a downtrending price channel that was fairly well established. That broke. Basically, it was in the second week of August once again. So we got above this resistance area at 82.24 and also above that downtrending channel line, which was potentially quite bullish for the U.S. dollar. It is important to note that the U.S. dollar has been capped by the 100-day moving average, which is this red line. You can see we challenged once in early July. We challenged again towards mid-July, and we challenged a third time just in the last week. And we've been unable to break above the 100-day moving average. Currently, the 100-day moving average is at 83.82. So any close on the U.S. dollar above 83.82 would be very bullish for the U.S. dollar. And because of the negative correlation currently in place between the U.S. dollar and the stock markets, a strong U.S. dollar will be indicative of a weak stock market and vice versa. So if we do close above the 100-day moving average on the U.S. dollar, that would be very bearish for the markets. By the same token, if we were able to break below this current support level, now at 82.24, and back into this congestion zone, that would be very bearish for the U.S. dollar, and by virtue of its negative correlation, very bullish for the world stock markets. Once again, we have to wait and see what's going to happen over the next week. As well as monitoring price action, it's very important that you monitor the internals of the market. For that, I use a number of different charts, but I want to talk on a couple of them today. The first one is the percentage of stocks on the New York Stock Exchange that are currently above their 50-day moving averages and above their 200-day moving averages. Once again, the 50-day moving average would be considered a short-term moving average, and the 200-day moving average a longer-term moving average. So in the short term, what this chart is telling us is that currently 47.48, so 48% of all the stocks on the New York Stock Exchange are above their 50-day moving average. So by virtue of that, you can see that 52% are below their 50-day moving average. So the majority of stocks currently are below their 50-day moving average. We'd like to see the percentage of stocks get back above 50, so that way the majority of the stocks in the short term are above their 50-day moving averages. We're currently not there, so it's still looking fairly bearish from a breadth point of view in the short term, based upon this chart. The next chart is, once again, the New York Stock Exchange percentage of stocks, but in this case it's above the 200-day moving average, which I said is more of a longer-term moving average. So in a long-term uptrend, you would like to see the majority of the stocks above their 200-day moving averages. And, of course, the converse in a downtrend, the majority will be below the 200-day moving average. And as you can see, as of today's close, 45% of all stocks on New York Stock Exchange were above their 200-day moving average. So conversely, that means that 55% were below their 200-day moving average. So the majority of stocks, once again, are below their 200-day moving average. We'd like to see that number get back above 50. So at least the majority are above their 200-day moving averages, which would be long-term bullish. We're not there yet. So as of today, once again, the breadth indication on the long term looks bearish. The last breadth chart I'd like to discuss is the high-low index chart. Essentially what this is a ratio of the number of new 52-week highs on the New York Stock Exchange versus the number of new 52-week lows. And what we'd like to do is we'd like to obviously see more new highs than new lows, which would be indicative of the underlying strength in the market supporting the price action. You can see that the actual new highs versus new lows topped out at about plus 280, and that was back in early August, and set up this bearish divergence where we had a series of lower numbers for new highs versus new lows, where the market was actually still sort of maintaining, as you can see, sort of a straight line. So that was one of the first indications that we were breaking down internally in the market. I've got this these two moving averages, which is the red is the 5-day EMA and the blue the 10-day EMA, to give me a short-term indication as the direction of the highs versus new lows. And as you can see, that broke down on about the 11th of August, and we are currently unable to gain the positive momentum ever since. So once again, the new highs versus new lows continues to drop. That is supporting the direction of the market, which is down. So as of today, there is no divergence in that. What I'd like to see is I'd like to see a lot of new highs versus new lows while the market continues to fall. That would indicate to me that the support underlying the market is getting stronger. As of today, we still don't have it. The only good news, if you want to have any good news, is that we are above the zero line. In other words, there's still more new highs versus new lows, which is a good sign. So if we can actually break this out and get going back in the north direction and get a 5 versus 10 crossover, that would be very bullish. But as of now, we're not there. So once again, my view of the markets is short-term, medium-term, and long-term. We're all looking quite bearish. We're holding that support zone, so a daily close below 1040 would be an indication I'm moving out of the Provident Fund back into cash, and also a weekly close below 1065 would be an indication as well that I would be closing out my equity positions in the Provident Fund and moving back into cash. This has been Dwayne Malone with the ECAM blog update. Hope you have a very pleasant day.